Up to $129 billion in individual tax relief is hitting American wallets this filing season. The IRS never updated 2025 withholding tables after Congress passed the One Big Beautiful Bill Act in July, so most workers overpaid taxes all year long. Treasury Secretary Besant himself says, expect $100 to $150 billion in refunds. Average refund bump? About $1,000 per filer, pushing the typical refund from roughly $3,052 to around $3,800. That's real money. But here's what nobody's telling you. That's your money being returned. Not a gift, not a bonus, not free cash from the government. It's your own paycheck that you gave the Treasury as an interest-free loan for 12 months. And when you see the lifestyle creep trap they've engineered with this delivery mechanism, you'll understand why getting a giant refund is the worst possible way to receive a tax cut. My name is Alex, and I've spent the last decade analyzing tax policy and personal finance behavior so you don't have to. I read IRS revenue procedures and Treasury reports for fun, which probably makes me weird, but it also means I see patterns most people miss. If you want to understand how the tax system actually works and how to keep more of your own money, make sure to hit that subscribe button and give this video a thumbs up if it helps you see through the noise. Quick question before we dive in. Are you expecting a bigger refund this year, or have you already adjusted your withholding to get more money in your paycheck? Let me know in the comments because I'm genuinely curious where you stand on this. Here's my thesis. The tax cuts are real. The provisions are substantial. But the way they're being delivered as massive lump sum refunds instead of higher monthly paychecks is specifically designed to trigger spending behavior instead of wealth building behavior. And when these temporary provisions expire in 2028, your tax bill jumps back up, but your lifestyle spending won't adjust down. That's the trap. Let me show you exactly how it works and what you can do instead. Most Americans think getting a bigger refund means they're winning at taxes. That's the biggest financial misconception in this country. A refund isn't free money. It's a forced savings account that pays zero interest while inflation eats away at the purchasing power. Think about it this way. If you overpaid your landlord by $300 every single month for a year, and at the end of that year they handed you back $3,600 with a smile and said congratulations, here's your refund, would you feel grateful? Or would you realize you just gave someone an interest-free loan for 12 months while you struggled to cover your actual expenses? That's exactly what's happening right now with tax refunds, except the scale is massive. The Tax Foundation estimates the One Big Beautiful Bill Act reduced individual income taxes by $109 billion for tax year 2025. Piper Sandler projects $91 billion arriving as higher refunds between February and April 2026, plus roughly $30 billion from reduced 2026 withholding, totaling about $121 billion in relief. But here's the thing that makes this year different. The IRS didn't update the 2025 withholding tables after the bill passed in July. Workers kept overpaying all year. The tax cuts are real, but the delivery mechanism, this giant lump sum refund, is the worst possible way to receive them. Let me explain why refunds are so abnormally large this specific year. When Congress passes tax legislation mid-year, the IRS is supposed to update the withholding tables so employers adjust how much they take out of your paycheck going forward. That didn't happen this time. The bill was signed July 4th, 2025. But the IRS didn't update the tables. So from July through December, you kept having the old higher amount withheld from every single paycheck. You were paying taxes at the old rates even though the new, lower rates were already law. Now, when you file your 2025 return, the IRS calculates what you actually owe under the new law. And the difference between what you paid and what you actually owed comes back as a refund. That's why this refund season is going to feel like Christmas for a lot of people. But here's what nobody discusses. That money could have been in your bank account earning interest every single month since July. Instead, it sat in the Treasury's account earning them the benefit. At current money market rates, about 4.5%, that $3,800 sitting in a high-yield savings account instead of with the IRS would have earned you roughly $170 over the year. Doesn't sound like much for one person. But multiply that across 100 million refund recipients. That's $17 billion in foregone interest, collectively. The government just borrowed $101 billion from American workers, interest-free, for an average of 6 to 12 months. And people are about to celebrate getting their own money back. Now let me show you what actually changed in the tax code, because the provisions themselves are significant. These are all effective for 2025 returns you're filing right now, and they're temporary through 2028. First, tips. You can now deduct up to $25,000 on qualified tips. This phases out at $150,000 of modified adjusted gross income if you're single, $300,000 if you're filing jointly. And this covers both employees and self-employed workers in traditionally tipped occupations: waiters, bartenders, delivery drivers, hairstylists. If you reported tip income, you can now deduct a big chunk of it. Second, overtime. You can deduct the half portion of time and a half overtime pay required under the Fair Labor Standards Act. Up to $12,500 if you're single, $25,000 if you're married filing jointly. Phases out at the same income thresholds: $100,000 single, $300,000 joint. But here's the critical detail most people are missing. Only FLSA required overtime qualifies. If your state mandates overtime rules that are more generous than federal law, or if your employer voluntarily pays you overtime when they're not legally required to, that doesn't count. This is specifically for federally mandated overtime only. Third, the senior deduction. An additional $6,000 per person age 65 or older, $12,000 for a qualifying couple. This phases out at $75,000 if you're single, $150,000 if you're married. And this is critical. This stacks on top of the existing standard deduction and the existing additional standard deduction for seniors that was already in the tax code. So if you're 65 or older, you're getting a triple stack of deductions this year. It's substantial. Fourth, car loan interest. You can deduct up to $10,000 in interest for new vehicle purchases. Used cars don't qualify. Leases don't qualify. It has to be a financed new vehicle. Phases out at $100,000 of income if you're single, $200,000 if you're married. This one is specifically designed to juice auto sales, and it's working. Dealerships are advertising this deduction in their financing offers. The standard deduction itself was raised retroactively for 2025. $15,750 single, $31,500 married filing jointly. For 2026, it rises again to $16,100 single, $32,200 joint. These are big numbers. Most people won't even need to itemize anymore. And then there's SALT. The state and local tax deduction cap was quadrupled from $10,000 to $40,000 for 2025 through 2029, but only for income under $500,000. If you're above $500,000, the cap phases down by 30 cents per dollar until it hits the old $10,000 floor. This cap rises 1% annually through 2029, then reverts to $10,000 in 2030. The biggest impact is in high-tax states: New York, New Jersey, California, Connecticut. If you're in one of those states and you itemize, this is a massive benefit. But you have to itemize to claim it, which means your total itemized deductions have to exceed the now much higher standard deduction. For a lot of people, even with the higher SALT cap, the standard deduction is still better. And finally, the child tax credit was bumped from $2,000 to $2,200, and it's now indexed to inflation going forward. Not huge, but it's something. What I'm about to show you next is the thing that took me years to figure out, and it's the part that actually matters. Everything before this was just the rules. Now we get to the psychology. Here's the trap nobody discusses. Research shows that people treat tax refunds as bonus money. A Talker research poll found that most filers use refunds for necessities: rent, food, credit card bills. Think about what that actually means. It means they're borrowing against themselves all year long, struggling to cover basic expenses, then catching up with their own money when the refund arrives. That's not a windfall. That's cash flow dysfunction. You're living below your means all year, not because you're saving, but because the government is withholding too much of your paycheck. Then when they return your own money, you use it to pay off the debt you accumulated while they were holding it. You're running in a circle. And here's where it gets worse. The psychology of a lump sum is completely different from the psychology of a monthly increase. If your paycheck goes up by $300 per month, you notice it, but it doesn't feel like a windfall. It feels like your new normal. You might save some of it. You might invest some of it. You adjust gradually. But when you get a $3,600 check all at once, your brain categorizes it differently. It feels like found money. It feels like you won something. And what do people do when they feel like they won something? They spend it. Not on investments, not on debt payoff, unless that debt is screaming at them. They spend it on the thing they've been wanting, the vacation. The new TB. The car down payment. The lifestyle upgrade. This is called mental accounting, and it's one of the most powerful forces in behavioral finance. Money is fungible. A dollar is a dollar whether you earned it in your paycheck or received it as a refund. But your brain doesn't treat it that way. Your brain puts different dollars in different mental buckets. Paycheck money goes in the bills and necessities bucket. Refund money goes in the discretionary bucket. And that's the trap the government has set for you, whether intentionally or not. Here's the formula for lifestyle creep. Temporary tax relief. These provisions expire after 2028, becomes a permanent spending increase. Let's say you're a server and you make $60,000 a year including tips. Under the new rules, you can deduct $25,000 of those tips. That saves you maybe $3,500 to $4,000 in taxes depending on your bracket. You get that back as a refund. You use it to finance a car, or take a vacation, or upgrade your apartment. Your lifestyle expands. You get used to that new level of spending. Then 2029 arrives. The tip deduction expires. Your tax bill jumps back up by $3,500 to $4,000. But your spending habits don't adjust down. You're still making the car payment. You're still living in the nicer apartment. Now you're underwater. You either go into debt or you scramble to cut expenses you've already gotten used to. And cutting expenses you're used to is psychologically brutal. It feels like losing something you earned even though you never actually earned it. It was always temporary. That's the lifestyle creep trap. Temporary income boost, permanent spending increase. When the income disappears, the spending doesn't. You're stuck. Now let me show you what most people won't figure out until it's too late. The majority of this refund benefit is captured by higher earners. Piper Sandler's analysis shows this clearly. The SALT cap increase, going from $10,000 to $40,000, primarily benefits households earning over $200,000 in high-tax states. If you're making $70,000 in Ohio, the SALT cap does nothing for you. If you're making $300,000 in New Jersey, it's a game changer. The tips and overtime deductions primarily benefit lower to middle income workers, but they're capped and temporary. The senior deduction helps, but again, it phases out if you have significant income. The car loan interest deduction phases out at modest six-figure incomes. The system's architecture disproportionately rewards people who already have financial infrastructure in place. If you're making $250,000 and you get an $8,000 refund, you probably have a brokerage account. You probably have a financial advisor. You probably already know to invest it. If you're making $50,000 and you get a $3,000 refund, you probably don't have any of that infrastructure. You probably have credit card debt. You probably have an emergency expense that's been waiting for you to have cash. The refund doesn't build wealth for you. It patches holes. If you've made it this far, you're already ahead of 90% of people. But don't stop now, because the next part is where everything clicks and I show you the actual solution. Here's what you need to do, and this applies whether you're getting a refund this year or not. First, adjust your W-4 withholding right now for 2026. The IRS has a withholding calculator on their website. Use it. The goal is to get your refund as close to zero as possible. Not because you're trying to owe money, you're not. You're trying to break even. You want to keep your money in your paycheck every month instead of loaning it to the government. If you're expecting a $3,600 refund this filing season, that means you're overpaying by $300 per month. Adjust your W-4 so that $300 stays in your paycheck. Second, and this is the part that matters, redirect that monthly difference into automatic investments or high-yield savings. $300 per month at 10% average annual return, which is roughly the stock market's historical average for 30 years, equals about $678,000. That same $3,600 per year received as a lump sum refund and spent equals zero. The difference between wealth and broke isn't your income, it's what you do with the margin. Third, if you're getting a refund this year, treat it like a one-time wealth building opportunity, not spending money. Open a brokerage account if you don't have one. Fidelity, Schwab, Vanguard, any of them work. Set up automatic monthly contributions. Start with whatever amount you can sustain, even if it's $50 a month. The goal is to build the infrastructure, the habit, the system. Put the refund into a low-cost index fund, an S&P 500 fund, a total market fund, something boring and diversified. Don't try to pick stocks, don't try to time the market, just put it in and leave it alone. Fourth, if you have high interest debt, credit card debt above 7 or 8% interest, pay that down first before investing. The guaranteed return of eliminating 15% interest debt is better than the uncertain return of the stock market. But if your debt is low interest, car loan at 4%, student loans at 5%, keep making minimum payments and invest the refund instead. The math favors investing when the expected return exceeds the interest rate you're paying. Fifth, if you don't have an emergency fund, build one. 3 to 6 months of expenses in a high-yield savings account. This isn't an investment. This is insurance against life. The refund is a perfect opportunity to build this cushion without feeling the pain of saving from your regular paycheck. Here's the real play that almost nobody executes. Use this refund season to build permanent infrastructure, not to fund temporary consumption. The tax relief is real but temporary. What you build with it is permanent. The system wants you to treat this like a windfall and spend it. That's what keeps the economy moving in the short term. Consumer spending goes up, GDP looks good, politicians take credit, but in the long term, you're no better off. You got a sugar rush of consumption, and then you're back to the same financial position you were in before, except now the tax cuts are about to expire and your tax bill is about to jump. The wealthy understand this instinctively. When they get a tax break, they don't spend it. They invest it, they build assets, they create income streams. The refund becomes seed capital. For everyone else, the refund becomes a spending spree, and that's why the wealth gap keeps widening. It's not about income, it's about what you do with the income. Now let me tie all of this together, because when you see how these pieces connect, everything changes. You're not getting a gift from the government, you're getting your own money back. The size of your refund is a measure of how much you overpaid, not how much you won. The tax cuts are real. The tips deduction, the overtime deduction, the senior deduction, the higher standard deduction, the SALT cap increase, all of it is real tax relief. But the delivery mechanism, the giant lump sum refund, is engineered to trigger spending behavior instead of wealth-building behavior. And because these provisions are temporary, expiring in 2028, the lifestyle creep they create becomes a trap when the provisions sunset. The real move is to adjust your withholding so you keep more money in your paycheck every month going forward. Then redirect that monthly difference into automatic investments or savings. Use this year's refund, if you're getting one, to build the infrastructure. Open the brokerage account. Set up the automatic contributions. Pay down high-interest debt. Build the emergency fund. Create the system that keeps working after the tax cuts expire. The question isn't whether you're getting a bigger refund this year. The question is what you're going to do with it, and whether you're going to fix the underlying problem so you stop giving the government interest-free loans in the first place. Your future self, 10 years from now, is either going to thank you for making the boring, disciplined decision to invest this money, or they're going to wonder where the hell it all went. The difference between those two outcomes is the decision you make in the next 30 days. Here's the hard truth that might sting a little. If you've been getting big refunds every year and you're still broke, the refund isn't helping you. It's enabling the dysfunction. You're using it as a forced savings account, but then you're blowing it instead of actually saving it. The government is acting as your financial parent, holding your money hostage so you can't spend it during the year, then giving it back to you in a lump sum, hoping you'll be responsible with it. And most people aren't. Most people treat it like a windfall and it's gone in 60 days. The people who build wealth don't operate this way. They don't get refunds because they've already optimized their withholding. They keep their money in their paycheck. They invest it monthly. They don't wait for the government to give them permission to save by withholding too much and returning it later. They take control of their own cash flow. And that's what you need to do. Stop celebrating the refund. Start celebrating the monthly margin. The $300 that stays in your paycheck every month is worth more than the $3,600 lump sum at the end of the year because you can put it to work immediately. Compounding works on time, not on lump sums. The sooner the money is invested, the longer it grows. Every month you let the government hold your money is a month you lose to compounding. This is the mindset shift that separates people who build wealth from people who stay broke. Broke people celebrate refunds. Wealthy people eliminate them. Broke people treat refunds as bonus money. Wealthy people treat refunds as a failure of planning. Broke people spend refunds. Wealthy people invest monthly. The tax code is the same for everyone. The outcomes are different because the behaviors are different. And here's the bigger picture issue that almost nobody is talking about. This entire refund season is a stress test for your financial discipline. The government just handed millions of Americans a lump sum of their own money and created a natural experiment. Who's going to invest it? Who's going to save it? Who's going to spend it? And the results of that experiment will determine who's financially free in 30 years and who's still struggling. The tax relief is real. The opportunity is real. But the trap is also real. Temporary provisions, permanent spending increases. That's the formula for financial disaster. What you need to do is invert it. Temporary refund, permanent infrastructure. Use the lump sum to build the system. Then use the system to build wealth. Let me leave you with this. 10 years from now, you're going to look back at this moment. You're either going to remember it as the tax year you finally got your financial house in order, or you're going to remember it as the year you got a big refund and have no idea where it went. The choice is yours, the money is yours, the opportunity is yours. But the window is closing. Refund season is happening right now. The money is hitting accounts in February, March, April. What you do with it in the next 90 days will determine your financial trajectory for the next decade. So here's what I want to know. What are you doing with your refund this year? Are you investing it? Paying off debt? Building an emergency fund? Or are you planning to spend it? Be honest in the comments. No judgment. I just want to know where this audience stands. And if there's another tax topic or financial strategy you want me to break down next, tell me below. That's what this channel is for. Your future millionaire self is counting on you to make the right call. Don't let them down.